What is uncertainty? In 2025, it might just have a name. From shifting tariffs to sudden extensions and exemptions, Trump's trade policy is anything but predictable. But what if uncertainty isn't something to fear? Hi everyone, I'm Petar Petrov, Senior Analyst at TradingKey. In this video, we will dive into 4 scenarios so you can navigate volatility and act with confidence. Before we start, remember to tap the like button. And without further ado, let's dive into the details. The first scenario assumes that the tariffs will slow economic growth but not trigger a recession. Supply-side cost pressures will rise, but weak domestic demand is expected to keep inflation in check, resulting in a low-growth, low-inflation environment. In this context, we expect the Fed to restart interest rate cuts later this year. In scenario 2, we assume tariffs escalate enough to push US into a recession, forcing the Fed to respond with aggressive rate cuts. In scenario 3, we assume tariffs slow down growth and fuel inflation. This outcome is a favorable setup for gold prices to rise. Weak growth enhances gold safe haven appeal, while rising inflation supports its value as a store of wealth. Lastly, scenario 4 assumes that Trump, facing overwhelming pressure from the public and the Congress, is forced to roll back most or all tariffs. While we view this as highly unlikely, if this were to happen, US equities would likely hit new heights in the near term. Among these 4 scenarios, scenario 1 has the highest probability, reinforcing our bullish stance on the S&P 500 over the next 3 months. The next big question is, how should investors position their portfolios to capture this opportunity? Let us know what you think in the comments below. With the new tariff package, we are seeing a wide range of impacts across different industries, with some sectors hit much harder than the others. In light of this, we are proposing 3 sector-based strategies for investors. In an environment of trade uncertainty, investors may rotate into low volatility sectors that are less exposed to tariffs and avoid high beta small cap growth stocks like the Russell 2000 index. We're talking about essential consumer goods, financials, and utilities, 78% of which have localized their supply chains within the US. In contrast, over 35% of the small cap growth firms remain heavily reliant on cross-border supply chains, with revenue risk exceeding 10% in some cases. In Q1, US active funds have begun rotating into consumer staples like food, retail, and household goods, while cutting exposure to discretionary sectors such as durables and apparel. With inflation still elevated and the risk of consumption downgrading ahead, we expect this trend to continue at least until the Fed begins rate cuts. US tech firms with global revenue exposure and minimal tariff risk are likely to benefit from fiscal and monetary easing. In 2025, Amazon, Microsoft, Google, and Meta are expecting to deploy over $300 billion in capex, with a major focus on AI infrastructure. AI's structural advantage and tariff resilience may give these tech names a significant profit margin boost. Now that we have covered sectors, let's zoom in further into individual stocks. New trade policies have created a clear divide. Some companies are heavily exposed, while others are relatively insulated or even well-positioned to benefit from disruption. Depending on your risk profile, here are 2 approaches. An offensive strategy would consist of going long on a company that stands to benefit from the new tariffs while shorting a company that is likely to suffer from them. This allows investors to capitalize on both sides of the policy shift, profiting from winners while betting against the losers. A defensive strategy, on the other hand, involves going long on a company that stands to benefit from the tariff shift, paired with a long position in a company that would typically be hurt by the tariffs. This provides a hedge against uncertainty, allowing investors to stay positioned for both outcomes. For the first strategy, we will use the cybersecurity sector as an example. The 2 industry giants there, Crowdstrike and Palo Alto, are seeing diverging investor sentiment. Even though both companies operate in the same space, their business models react differently to the tariff pressure. Crowdstrike focuses on cloud-native, subscription-based endpoint and cloud security. Without relying on physical hardware products, it carries minimal exposure to tariffs. In contrast, Palo Alto derives nearly 20% of its revenue from physical product sales, especially its ML-powered next-generation firewalls. This hardware exposure creates greater vulnerability to supply chain disruptions and cost pressure under a trade war scenario. Historically, the 2 stocks have moved in close correlation. However, since Trump election in November, CrowdStrike has significantly outperformed Palo Alto, highlighting how even companies in the same industries can diverge based on tariff sensitivity. For the second strategy, we can see opportunities within e-commerce. Temu, the ultra-discounted platform under Pinduoduo, built its US success on low-cost and direct from China shipping. However, its business model has come under severe pressure with the closing of the de minimis loophole, which previously allowed items under $800 to enter the US duty-free. With that loophole closed, Temu's competitive edge is rapidly eroding. Meanwhile, ThredUp, a US-based second-hand fashion platform, has emerged as a surprising closing winner. ThredUp's inventory is sourced domestically, insulated from the tariff pressure. More importantly, the second-hand market is inherently counter-cyclical. As the economy slows and consumers become more price-sensitive, demand for resale platforms tend to rise. Since the tariff announcement in early April, Thread stock has surged over 160%, while Pinduoduo is down 10%. Uncertainty may dominate the headlines, but with the right tools, investors can turn it into an edge. Whether it's defensive positioning or identifying asymmetric winners, the trade war has created both risk and opportunity. If you found this breakdown helpful, be sure to like the video, subscribe, and drop your thoughts in the comments. We would love to hear what sectors and stocks you're watching right now. Stay informed, stay strategic, and we'll see you in the next one.